gains. Kathryn Rooney Vera is head of research strategy at Baltic Capital Markets, and she joins us with her take on the markets. Let's just start with this tug of war we're seeing in the first couple of minutes here. Kathryn, what do you make of it?
Well, certainly it's the market trying to regain ground from some turbulent past couple of weeks. The inflation scare, of course, sends equities lower and risk appetite off. So I think the market is looking to find itself and look for direction, John.
What do you think that direction ultimately looks like?
Well, while the Fed continues to buy $120 billion a month, $40 billion of which go to mortgage-backed securities, all the rest go to treasuries, I think that the outlook is very rosy. I guess the question we have to ask ourselves, John, is should the Fed be buying, should the Fed be employing massive emergency measures when we are definitively in a strong recovery, unlike that which we've seen since maybe the Second World War?
Okay, so I'll play devil's advocate just for some fun
Sure.
here, and I'll look at the jobs market. And I know you guys are getting back to a version of normal right now in the United States. People getting out there, but you keep hearing this story about employers struggling to find the right people
Sure.
for a particular position. And overall, I think that there was a belief that as encouraging as some parts of the job market have been, that it might be even stronger at this point.
Well, let's face it, we're back to job openings that were at pre-pandemic levels, John. So we have 8.5 million jobs that are available, but we have a dearth of people looking for those jobs. In other words, we have about 40% of companies here in the United States that have said that they have had trouble filling at least one position within their firm, and that's despite an abundance of job openings. So a lot of this goes back to government measures, John, that I think are important to consider that during an emergency perhaps are warranted. But the difficult thing is extricating ourselves from a policy perspective, especially from the government, extricating ourselves from those emergency measures and determining when they are no longer needed. And in fact, I think at this point, John, we are entering into a scenario where they are counterproductive. So hopefully going forward, we see policy adjustments, not just from the fiscal side, not just from perhaps reining in the spending, rather than talking of additional multi-trillions of dollars that the United States can for sure not afford, but also on the monetary side. And so that the Fed looks at these, what they call exclusively transitory inflationary pressures, and they look at the dearth of offering in the real estate market and say, maybe we don't need to employ such aggressive emergency measures and keep this market bubble and froth going. I think that's the real risk here, and I suspect that the markets are going to continue to do very well while we have these emergency measures continuing until we're brought up against a wall, either of higher inflation that the Fed can no longer ignore and says is definitively structural rather than temporary in nature, and has to start thinking and talking about tapering and rate hikes. And I suspect that that's when the party ends, John.
All right. Well, that's helpful context, and we certainly don't like being counterproductive for our audience, which is why I'm so glad you came to the table today. We keep talking about inflation, the inflation debate. You've come with some investor hedges on the inflation front. If you think this is a reality that's not going away, whether it's bonds or the real estate market or commodities or stocks, you've got a few ideas.
Absolutely, and they've already flown, John. These are ideas that we've had at Baltic for the past 6 months, calling on inflation ahead of consensus that this was a real concern, even before it was a headlining issue. And what we've recommended without a question is a weaker dollar, which means that commodities are a great play. Even gold, which has lost its luster in front of Bitcoin and cryptocurrencies, I think is a good thing to have in your portfolio, as well as sectors in the S&P 500. Of the 11 sectors, there are certainly 4 or 5 standouts. And they include energy, they include utilities, they include real estate, staples. These are sectors that you can mathematically prove outperform in terms of returns during inflationary periods. So if one thinks that, yes, there are certainly some aspects of recent inflation data that are transitory in nature, namely, this month, year-over-year comparison, given that last year was so horrific, or the chips shortage, or the raw material shortage. Certainly those things are transitory in nature. What is not, though, John, is 30% fiscal deficit to GDP and an ongoing push for additional spending, or emergency measures from the monetary side that keep getting pushed and used when they're no longer needed, or M2, M1 still in double-digit annual growth with velocity of money beginning to rise. All of these things, and I have to include demand pull inflation, all of these things to me say that while we do have some sparks of a transitory nature in these inflation data, which I've already named, there is a structural undercurrent that is going to bring inflation to the fore sooner rather than later. And I think that clients, at least our clients and your audience, should be preparing for that today. So that can include tips, commodities, gold, real estate, alternative investments, even cryptocurrencies, low correlation assets that thrive in an environment, or industries or companies that thrive in an environment of inflation and or can pass along their costs, are where you want to have at least some exposure in your portfolio to hedge against the drop that will, I think, come once you get talk of taper and once you get the inevitable increase in interest rates, which I think we should already be talking about here in the United States, but we're the furthest thing from that.